You want to hear a little known secret about rental properties that could save you big on taxes? All right, listen up. If you're renting out on platforms like Airbnb or VRBO, you could be missing out on some serious tax benefits. So let's dive in. So here's the deal. If your average guest stays for 7 days or less, the IRS considers it a short-term rental. This little detail can make a huge difference in your tax savings. So what can you deduct? Well, a ton of stuff. We're talking mortgage interest, property taxes, insurance, repairs, utilities, even the fees for bookkeeping and legal services. Yes, you can write off the cost of keeping those records straight. Most people only think about cleaning and maintenance costs, but there are so many more expenses that you can deduct. Now, here's where it gets even juicier. So short-term rentals can sometimes be better for tax returns because they allow you to have active losses. So this means you're hands-on with managing your property, and you can use those losses to offset other income. Active participation means you're spending at least 100 hours a year on rental activities. So this could be handling the bookings, coordinating cleanings, other hands-on management. So let's break down the benefits a bit more. If you are actively involved in your short-term rental, you can offset other income with your rental losses. This is huge. It's a huge advantage compared to long-term rentals where the losses might be limited or be suspended. So for example, if you have a high-income job and a short-term rental property, you can use those rental losses to lower your overall taxable income. But wait, there's more. If you qualify as a real estate professional, the benefits are even greater. Real estate professionals can deduct rental losses without the usual passive loss limitations. So this means you can take full advantage of your rental property's expenses and lower your tax bill significantly. Now, we'll say there are some downsides to the real estate professional that you need to know about before you implement this, but that's where we come in. Another cool tip is the 14-day rental rule. It's also known as the Augusta Rule. If you rent out your property for 14 days or less in a year, you don't have to pay taxes on that rental income. This is perfect if you live near popular events where you can rent out your space for a short period at a high tax rate. So let's talk about some real-life examples for a minute. So imagine client one owns a short-term rental. In 2024, he had $20,000 in income and $45,000 in expenses. So this gives him a $25,000 loss. Because he actively participated in managing the property and met that 100-hour rule, he could deduct the loss from his other income, which saves a ton on taxes. So on the flip side, client 2 has a long-term rental with $20,000 same income and $25,000 in expenses, so less. And he's got a $5,000 loss. But he doesn't actively participate, and his AGI is over the limit, so he can't deduct that loss at all. It just gets carried forward to future years when he might have some passive income to offset it, like when he sells the property. So if you're deciding between a short-term rental and a long-term rental, consider the tax benefits. Short-term rentals can offer you more flexibility and a bigger tax savings if you're actively involved. There's also some big depreciation implications here. Long-term rentals have their perks too, but they also come with more restrictions on deducting the losses. So in short, if you're renting out your property for short stays, you can unlock some big tax breaks. If you want to know more, get in touch with us and let's see how we can maximize your rental property's potential. Happy renting!